Assalamualaikum dear students. My name is Indra Mughal, Business Faculty at Sindhu University Campus, Larkana, and I am teaching you the subject named Principles of Insurance. Today I am going to teach you the types of insurance, the lecture number 5th. In this lecture you will be able to learn these objectives: types of insurance and types of general insurance. Each and every individual in the world has to deal with risks of various kinds and degrees, which involve exposure to losses. Risk is everywhere. When you drive your car to work, when you visit a new country, when you ride your bike to a nearby shop, when there is a new bug going around in town. To overcome these situations and to minimize the loss arising out of occurrence of the risks, a device had been developed known as insurance. So now we discuss on the insurance. So what is the insurance? Insurance is defined as a contract whereby one person called the insurer undertakes to make good for the losses of another called the insured on payment of a specific sum of money called premium to him on the happening of a specified event. Thus, insurance is a cooperative device to spread the loss caused by a particular risk over a number of persons who are exposed to it and who agree to insure themselves against the risk. So, you need the security of insurance. Here we discuss the two broad types of insurance. One is the life insurance and second general insurance. Now we discuss both in detail in next slides. In this slide we discuss the why you need life insurance. Consider this scenario: a friend of yours meets with an accident. He unfortunately passes away and is survived by a wife, 2 kids, and one elderly parent. He had minimal savings, which are barely enough to cover 3 months' worth of basic expenses like bills, groceries, and so on. A life insurance plan could have ensured that if he paid a premium worth 7,500 rupees, the family would receive around 10 lakhs under the circumstances, and therefore be financially cushioned to continue their lives amidst this loss. This example that I have read told us that where life insurance policies can help mitigate the financial burden. What is life insurance? Life insurance is a contract that offers financial compensation in case of death or disability. Some life insurance policies even offer financial compensation after retirement or a certain period of time. Life insurance thus helps you secure your family's financial security even in your absence. You either make a lump sum payment while purchasing a life insurance policy or make periodic payments to the insurer. These are known as premiums. In exchange, your insurer promises to pay an insured sum to your family in the event of death, disability, or at a set time. Life insurance can help you support your family even after retirement, depending on what it covers. Life insurance can be classified into various types, which are term insurance, whole life insurance, endowment policy, money back policy, ULIP, child plan, and pension plans. Term insurance, one of the type of life insurance. It is the most basic type of insurance. It covers you for a specific period. The term insurance is initially much less expensive when compared to other life insurances. Your family gets a lump sum amount in the case of your death. If the insured dies during the time period specified in the policy and the policy is active or in force, a death benefit will be paid. If, however, you survive the term, no money will be paid to you or your family. In other words, we can say the only value is the guaranteed death benefit from the policy. Whole life insurance is a second type of life insurance. It covers you for a lifetime. Your family receives a certain sum of money after your death. They will also be entitled to a bonus that often occurs on such amount. As this scheme has been offered by the State Life Insurance Corporation, Pakistan, and they stated this scheme as it is a unique combination of protection and savings at a very economical premium. Death at any time before age 85 years terminates payment of premiums and the sum insured and attached bonuses become payable. In the event the insured survives to the policy anniversary at age 85 years, the policy matures and the sum insured plus bonuses become payable. Under this plan, the rates of bonuses are usually much higher than the other plans, and they help in increasing not only protection but also the investment element of the policy substantially. Endowment policy. Like a term policy, it is also valid for a certain period. A lump sum amount will be paid to your family in the event of your death. Unlike a term plan, you get the maturity proceeds after the term period. Endowment insurance plans also offer tax benefits. The premiums you pay can help you reduce your taxable income. This plan is available to all Bank Alpha Limited customers between 20 to 65 years of age, with minimum term 10 years and maximum term by the age of 75 years. And this plan also offered by the State Life, which they said that it's a safest and surest method of guaranteed cash provision, either at a specified time or at death. Under these policies, the sum insured plus bonuses are payable at the end of the specified number of years or at death of the life insured, if earlier. Premiums are payable for the specified number of years or till death, if earlier. The benefits under the plan can be further increased by attaching supplementary covers. The plan serves the requirements of a family in various shapes by the way of financial help at retirement, education of children, or provision of capital for business. Money back policy. A certain percentage of the sum assured will be paid to you periodically throughout the term as survival benefit. After the expiry of the term, you get the balance amount as maturity proceeds. Your family gets the entire sum assured in case of death during the policy period. This is the regardless of the survival benefit payments made. Let's take an example. In the case of 20-year money back policy, 20% of the sum assured becomes payable each after 5, 10, and 15 years, and the balance of 40% plus the acquired bonus. 40% plus the acquired bonus become payable at the 20th year. Unit linked insurance plans, ULIP. A unit linked insurance plan, ULIP, is a multifaceted product issued by insurance companies that combine insurance coverage and investment exposure in a single offering. A part of your premium goes towards your insurance cover. The remaining amount is invested in debt and equity markets. A lump sum amount will be paid to your family in the event of your death. Child plan. This ensures your child's financial security. In the event of your death, your child gets a lump sum amount. The insurer pays the premium amount after your death. Your child will continue to get a certain sum of money at specific intervals. Pension plans. This helps build your retirement fund. You can get a regular pension amount after retirement. In the case of your death, your family can claim the sum assured.